For 2 full years, I thought I had found the holy grail of trading signals. Every time I spotted a bullish divergence on the MACD, price making a lower low, but the histogram not confirming, I told myself, the bottom is in. Time to buy? And for 2 years, the market proved me wrong, over and over again. Today I'm going to show you the exact mistake I was making and why bullish divergence is not a bottom signal. If you've ever blown a trade using this pattern, stay with me. Here's exactly how I used to think. Step 1. I spot a bullish divergence. Price is printing a lower low, but the MACD histogram is higher than the previous low. My brain says, the selling pressure is drying up. The bottom must be here. Step 2. I go heavy. Full size. Tight stop loss because I'm confident in the signal. Step 3. I wait for the explosion to the upside. And then, price just keeps dropping. Stop hit. A countdown. Again. Here's the core misconception most traders have. Divergence does not mean reversal. It means momentum is weakening. When you see a bullish divergence, MACD is telling you one specific thing. The energy behind this downward move is fading. That's it. It is not telling you the trend is over. It's simply saying the sellers are getting tired. Let me give you the analogy that finally made this click for me. Think about dropping a ping pong ball from a height. First bounce, high. Second bounce, lower. Third bounce, lower still. Each bounce represents a bullish divergence. Each time, the ball loses energy. But the ball is still hitting the floor every single time. It hasn't stopped falling. It's just falling with less force. Let me walk you through the most dangerous version of this mistake. Price is in a clear downtrend. It drops hard and forms a first low. Then MACD shows a bullish divergence. Price bounces slightly, just enough to give you hope. You enter long. And then, price breaks through everything, makes a new significant low, and your stop gets taken out. The divergence gave you the illusion of a bottom. The trend gave you the reality of continued pain. So does bullish divergence have any value at all? Absolutely. But you have to use it in the right context. Wrong context. You're in a clear downtrend and you use divergence to call a reversal. Right context. Price is in an uptrend, there's a pullback, and you spot a bullish divergence. Now you're using divergence to join the trend at a better price, not to fight the trend. Divergence plus trend alignment equals a high probability setup. Divergence against the trend equals a high probability loss. Let me give you one concrete rule I use every single day. The EMA 52. If price is trading above the EMA 52, a bullish divergence is a legitimate long entry signal. You're with the trend. High probability. If price is trading below the EMA 52, divergence is telling you there might be a bounce, but it's counter trend. At most, wait for price to bounce toward the EMA 208, and that might be your short entry. The EMA 52 is your dividing line between bullish and bearish bias. So here's the summary. Bullish divergence does not mean the bottom is in. It means downside momentum is weakening. Use it with the trend, not against it. Filter every setup through the EMA 52. If this is a mistake you've made before, drop a comment below. Next video, why MACD golden crosses are almost always a late entry, and what professional traders actually look for instead. See you there.